Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today we've got another position update. For those of you who are new to the channel, I do manage a portfolio on eToro. It's a great way for me to put my theses out there publicly and to get a real-time no-nonsense report back as to my performance as a fund manager. So I manage a portfolio on there. We're going to be talking about one position that's of keen interest today. And last year I did a video when I took out a position, the initial position in this company. And so we're going to see, was I right, was I wrong, how's it performing? And hopefully you got a lot of value out of comparing my thoughts then as to what's been revealed in the few months since we've taken a position in the company. And so, yeah, as I say, hopefully you get a lot of value. If you haven't already liked and subscribed, I would love it if you could do that to the channel. It really helps the algorithm start to grow. Thank you to those, well over 500 now. So thank you to all those who have subscribed. Today we're talking about Cenovus Energy, okay? Very important player in the Canadian oil and sands, okay? Our position here, as you can see, this is the portfolio that I manage. Here you've got 3.58%. That's the initial weighting that I gave the position in terms of the amount of capital under management allocated towards the position. It's since grown in a matter of a few months, and almost 20%, we'll call it. So it makes up around 4% of the assets under management. So it's a significant position in the fund, and it has been a great outperformer. And I believe that this is a classic example of price action. Although it's what gains most people's interest, it's not the most important thing. Something can go up in price and go up in value even more. And so I think that Cenovus today is actually more value than it was when we first took our initial stake. So here we go. I'm going to move over into trusty PowerPoint because I'm rather lazy when it comes to presentation, and they've got their own slide designers here, which makes my life a hell of a lot easier. But it helps me to illustrate the points and just keep the information in one particular place so that you can focus your attention there. So as you can see, Cenovus Energy, we're up almost 20% since our initial stake in the position. And so what has occurred? Going to start off with this quote here from Eric Nuttall. Eric Nuttall is a famous partner of 9 Point Asset Management in Canada. It's an energy exclusive fund, and so Eric is certainly the man when it comes to talking about the Canadian mid caps, which as a rule at the moment, or as a class, I believe are it's still undervalued. They were incredibly cheap during COVID, and now they're still continuing to be cheap, even though oil is well over $80 per barrel WTI. So I believed with every fibre of my being that we were staring at a generational opportunity given the implosion in energy stock prices. And he's talking about, obviously, post-March 2020 when oil futures went negative. So the people in charge of the world decided to lock everyone up, and so the fuel demand basically was expected to drop off a cliff when it comes to, obviously, no international flights, domestic flights basically down to a thin fraction of what they would normally be. And so energy futures, particularly oil, sold off, and they actually went negative, meaning if you were the owner of a futures contract, you had to pay someone to take the futures contract off your hands. Okay, very bizarre set of circumstances. Who knows if we'll ever see that again in our lifetimes. Moving on, so the recap as to the thesis, I've spoken a lot about the energy space. Why? Because it's the best opportunity in terms of a macro play today, in my opinion, and because of that, I've weighted most of my investments both in the eToro fund and in my personal fund towards the energy sector. So we're overweight. We're about 15 to 16% energy. Now it's broken up. It's not all oil and gas. It's into different sectors or different industries in that sector. But energy is the place where most of the opportunities that I'm seeing are, in my opinion. So from a macro top-down perspective, we've had a dearth of supply side capex leading into 2020 anyway. So the point of that means that up to 2015, you had this boom in US shale. Basically, if you could spell oil or fracking, they would throw money at you. So these companies went out and borrowed a heap, used that debt financing to invest in new wells, new drill rigs, new capex of all sorts. They were going to increase their production from the debt financing. Now, that's all well and good when you're making money, but of course, with every man and his dog jumping into the oil game, in terms of shale and fracking, you started to have an oversupply. Oil prices came down. These companies were no longer profitable. They started to default. There were bankruptcies, and obviously with the huge debt load that they had. And so since we've kind of been coming off that high in 2015, so things were already bad in terms of supply side starting to constrain prior to 2020. Then, of course, we had COVID, which ruined everything in terms of a supply chain. There's not much I can think of that's increased in supply over the last 2 years. The change of the White House was also a catalyst for disruption, particularly for the US. Okay, so the US used to be energy independent, meaning they could export more than they import, and they could look after their own energy needs, basically. And obviously, the incredibly intelligent people in charge of the White House at the moment decided that they didn't like that idea. They gave in to the eco-terrorists and whoever else is out there that decided there would be no more permits given for fracking on federal land. Okay, so the US now has lost a heap of its production, and so this has just continued to accelerate the already decaying rate of supply in the US. We have OPEC Plus unable or unwilling to meet the demand for production increases. So the Americans decided that they didn't want to have oil production in their backyard for political reasons, but they didn't want the oil price to get too high. So those people over in the Middle East and Nigeria, Venezuela, Russia, and so on and so forth, they have to start pumping more. Not us, but they do. So we can keep the price down, so we can continue to use oil and tell everyone we're really good people. So obviously that doesn't make sense. The Middle East and Russia have been failing to meet their quotas. It is suspected among certain commentators, particularly Josh Young, who's a very, very keen mind in this space, running his fund out of Houston, that they actually don't have the capacity that they say they do, or at least they cannot bring the supply online in a timely fashion. So moving down into the meso-economic view, producers learned from 2015 that oversupply from debt-funded capex had to end. It was a story that had to end. Okay, so this time around, coming into an oil bull market or energy bull market, I'm using oil because we're talking about an oil and gas company, then there is a significant difference in terms of the management have learned that, hey, when the going is good, we're not going to reach out, have a whole binge on debt financing into creation of new capex. We're all going to kind of agree not to flood the market with increased production in order to keep the prices stable. And I think that will keep a floor under the spot price, particularly those in Canada and Cenovus, focusing on returning value to shareholders. So instead of using their free cash and acquiring more and more debt to increase their production, they're looking to return that cash back to shareholders. They're going to pay down their debt levels first to an appropriate amount. Once they hit their targets, which Cenovus has, they're going to buy back stock and they're going to issue dividends. Okay, so they're going to be gushing cash flow from here on in for at least another decade. The large caps. So how do you play that? We see a theme. It doesn't mean that every player in that theme is going to win. The large caps, in my opinion, are screwed. Okay, they can't do anything productive now. Their cost of capital is through the roof. They can't get bank financing. So even if they wanted to, they couldn't, because there's just such a stigma about lending to these companies. I mean, this is kind of like a corporate finance apartheid, only instead of being based on race, it's based on energy sources. I mean, it's truly it's going to have a bad ending. But anyway, Exxon, for example, I put Exxon in here. Exxon, I think like less than 0.2% of its shareholders were part of this activist fund, and they somehow weaseled their way into the board, and they basically started to vote. They had to have the power and the voting rights within the company that are involved in some quite destructive processes for Exxon, the sale of assets and selling them for cents on the dollar. It's really quite bizarre. So you can go and read more about that. I did speak about it in another video. But the point of the matter is, this is where the macro and the meso is heading. So we worked out a good position in terms of Canadian mid-caps looking very promising. So who are the players in there that we would like to be a part of? Okay, that's the key. I own a few of them in my outside funds. For eToro, I've chosen to go with Cenovus because I think it's the leading horse in the race. Okay, so what I've done with the format today, I've taken slides from when I first gave my initial thoughts, and so I've gone over and edited to see how accurate those thoughts were or were not. So we know that Cenovus is the major player in the Canadian oil and gas space. Having merged with Husky Energy, they have the biggest refining capacity, I believe, in Canada. Okay. Now, the Prime Minister of Canada is quite insane. However, in order to hold his power, he'll need to be able to keep citizens happy, and that requires energy. So I expect Cenovus to come under pressure as well, but eventually when the dust settles, I think we're all going to realize that we need oil and gas for a long, long time still to come, and Cenovus now is in the best position to take advantage of that and benefit. So the cost synergies, breaking even at $36 WTI, which is important. So we had an expected free cash flow to enterprise value yield of 16%. Why do we use enterprise value instead of market cap? Because that takes into account the debt of the companies. Okay, these companies still have a bit of a hangover in terms of their debt load. Cenovus is paying theirs down, but it's important to take into account enterprise value as opposed to market cap. Otherwise, if you just look at free cash flow over market cap, it will look absurdly high. It was trading around 1 times its book value. You'll notice it's been bid up. Okay, so it's been bid up and it's now trading for 1.4 times the book value. Part of that is to do with the debt being paid down. Part of that is also to do with the sale of some of their assets. So they sold about $600 million worth of, I suppose, what the management thought was non-core assets. And so that's lightened up the balance sheet, making it a lean and nimble company to take advantage of the future. Debt reduction program. So at the time I was saying this is what they're saying they're going to do. They've since done that. So the management seems to be executing quite well, and they have promised 50% of the free cash flow will go to dividends and repurchases once they hit that. So now we're in the position where we are going to be reaping the fruits of the labor. They've had the discipline to pay down the debt, and so now they'll be looking to capitalize and return the capital, the free cash, to shareholders. Okay, so with Cenovus on the cusp of reaching their initial deleveraging target, that's what I spoke about before, they've committed to buying back 7% of the float. 7% of the entire company, gone. In the sense of management buying it back and tearing up the shares. That is fantastic for us as shareholders. That's like getting a 7% increase on our investment without having to do anything and without having to pay tax on it, which is fantastic. Trading at a material discount to other Canadian and US peers. That is interesting because they are the main player in the Canadian oil and sand space. And with the merger with Husky, I think it was a great merger. They've positioned themselves very, very well. So it's interesting that it still trades at a relative discount in terms of valuation to its peers. We own Ovintiv in the US because I wanted access to the US sort of Midwestern players. Otherwise, I would have tipped a little more into Cenovus. We look for significant multiple expansion as the company continues to deleverage and return capital back to shareholders. And that's what I've been talking about. If we get this twin turbos of growing earnings and growing valuation multiples that Peter Lynch talks about, that is where you really start to supercharge your investment returns. And so we'd expect that over the next few years when it comes to Cenovus. Trading at 3.7 times enterprise value to cash flow and a 23% free cash flow yield at $70 oil. Okay, so West Texas Intermediate, $70 a barrel. We see the ability to meaningfully increase the dividend and announced buyback in 2022. So they can even increase and buy back more of the float plus pay out some special dividends. With a target multiple of 6x, we see more than 100% potential upside from US $80 WTI per barrel. So we're at $80 WTI at the moment. So Mr. Nuttall here seems to be right on the money. The only thing that's lacking now is we're waiting for this target multiple of 6 times on the upside. So we're going to plug in those multiples and see what that would look like. Apologies for the blurry shot. This has been taken off Twitter. Here's Cenovus. Okay, so this is where if we're looking at $80 WTI on the right, Cenovus is here. So this is how many years it would take back for the company to buy back itself, basically pay down its debt. Okay, so free cash flow yield, okay, to market cap on the y-axis, and then the debt to the cash flow. So you can see they basically have no more debt above their cash flow, so they can easily service the debt. And so it's just crazy to look at. So I think it's an insane opportunity in terms of the entire sector. And there's Cenovus here. I own some of these others in the outside fund, but Cenovus is the one I've chosen to go with in terms of the eToro fund. Ooh, skipped ahead there accidentally. Okay, here we go. So this is the projections from last year. Okay, the initial projections were here on the left hand side, and as you'll see, they're beaten in every single column. Okay, so let's have a look. They're expected to end 2022, so at the end of this year, with these estimates here in green. Okay, so the green, and I apologize for my terrible writing, the expected numbers on a per share basis for free cash flow, EBITDA, and earnings. Here we've left the multiples the same. So if we were to get that 6 times EV to EBITDA, and I've even gone with just a 5 times market cap to free cash flow, these are the suggested prices. Equally weighted average, I've now upgraded the target price for Cenovus from $17.44 to $19.47. Okay, so we could have more than a 50% upside from here. Very, very good in terms of investment returns. So although the price may have increased, I believe that the value has also increased in lockstep, and it's not always the case. Initially, I had an intrinsic value of $19.13, so that was the first sort of calculation. Revising that this afternoon, here's what I have come up with in terms of adjustments. I believe the intrinsic value is more like $26.14 if you wanted to get a 20% IRR compounded over the long term, using the growth rates associated here for a base case, a bull case, and a bear case. And as I always do, I use earnings, free cash flow, and EBITDA. The earnings will still have a lot of non-cash write-downs, okay? So that's why you see the valuation here in terms of intrinsic value for the earnings is about half that of the free cash flow and the EBITDA, because remember, it's lower down on the income sheet, the reporting sheet, and so it will take into account depreciation and other non-cash expenses. So that's why it always looks a little bit lower. Here's our original estimate as to the IRR. So we got in at around about $11.74. These are the expected cash flows out to the future. Look at the cost of capital, 17%. 17% is, the interest rates that these companies have to pay. I mean, it's usury. Anyway, I've spoken enough about that, I think. So here we've got from today, if you buy the shares at today and have the expected cash flows growing at the same rate, okay, so same rate of growth for the cash flows over the next 10 years, same exit multiple at today's price as an entry, discounted at the cost of capital, and we've got an increase, okay, so the delta between what I expect now versus what I expected 6 months ago has actually increased from an IRR perspective. So if all this holds to be true and correct, which, I mean, obviously it depends on the oil price, which is going to be volatile, we can expect around about $26.55 in terms of an IRR at the current prices. So obviously that's something that is interesting, and so we would expect that to beat the market in most years, if not every year. Okay. Thanks for watching. If you haven't already liked and subscribed to the channel, please do so. It helps me out a lot. And so if you want to see more videos, like and subscribe. If you haven't already added us to a watch list on eToro, click on the link and you'll be taken to the eToro page where you can add us to a watch list. If you're looking to invest and you're not confident in your own skills and you want to allocate a little bit of money to a value and a growth fund, you can use the copy trader function on eToro, where you can put your money down and hit the copy button, and what happens is your portfolio then will be mirrored with mine, and so you'll be able to share in the gains or the losses, and I'll do the hard work. Okay, as always guys, disclaimer, I'm not your financial advisor, okay? So this channel is all my opinions and what I'm doing with my money and the money that I'm in charge of. That's all it is. it's up to you in terms of deciding what to do with your personal funds. If you need to seek financial advice, go and seek financial advice specific to you. That's not on this channel. I have no idea who you are, so make sure you use your common sense and discretion and take responsibility for your own actions. Everything I say here is just an opinion. Having said that, I hope you enjoyed it and I hope you got a bit of value out of it, and I look forward to seeing you hopefully in another video. If there's a company you want me to review, leave it in the comment section. If there's a position in the Toro portfolio that you want me to go over, leave a comment in the comment section. Otherwise, I'll continue to kind of chip through and give updates where I think they're most valuable. The fund is performing very well, so I'm keeping an eye out on some other companies that I might add as a new position, but I don't really want to give up anything that we've got at the moment. I think we're here, we're ready to just sit back and let the market realize how correct we were during the last year. Okay, but we'll see. Thanks for watching. I'll see you next time.